But earnings, of course, are keeping us busy. RBL Bank is the next we're going to talk about. The third quarter earnings came in slightly below street expectations. Slippages have gone up. They're about 3.5% or so. Asset quality has deteriorated. Retail loan growth momentum looks strong. We have the management, Mr. R. Subramaniakumar, Managing Director and Chief Executive Officer at RBL Bank, joining us to take some questions. Sir, good morning. Great to have you with us here. It's always a pleasure hosting you here on CNBC-TV18. Prashant this side. Just talk us through some of the basic hygiene aspects. One, that provision against AIF investments of a little over 100 crores or so. I think that has curtailed sort of profits in the quarter, returns in the quarter. Talk to us a little bit about slippages as well in terms of, what is the breakup that you saw?
Good, Prashant. Thank you. Good morning to all of you. So first of all, this quarter has been an exceptionally great quarter for RBL. And some of the parameters, especially in the profit parameters, if I just set aside the AIF for the minute, the PAT grew by 53%. And sequentially also it grew substantially high. And ROA was as per the guidance at 1.03. However, the AIF should be looked from slightly a different angle, because this is a new direction which has come from the regulator in respect of the investments made in AIF. If the downstream, the AIF has given to the borrowers, if the customers are common between the bank as well as them, you have to either liquidate it or you have to provide for. The time available was 30 days, and you will definitely agree that it is too short a period for such a liquid fund is to be taken care. However, our investment in AIF is to be, it is a long term, it is highly disinvested funds where we have gone in. Our exposure is only 4 to 5% of the total. And we have the relationship with all these funds for the last 8 to 10 years. And we don't see any stress in those assets with which we have also been exposed to, where the AIF is also exposed. And it is extremely diversified fund. And nevertheless, we wanted to be on the right side of the direction. So we went in for the provisions of 115 crore, which is out of total 121 crores, which we have invested. 115 is eligible or entitled to be provided for, which we have provided. So if suppose I keep that aside, the profit growth has been exceptionally well. Now coming to the point, what we said about the slippage. First of all, the slippage is not alarming. Yeah.
So, sorry, just the slippage, before the slippage thing, you said AIF investment is 4 to 5%, you said?
No, the AIF investment in the funds in which we have invested, our share is 4 to 5% out of the total fund size. Okay. It is not ours. Okay. Ours is total 121.
Yes, that's what I thought. Yes, go on, sir. Go on with the slippage number. Yeah, the slippage breakup.
Yes, Prashant. See, as far as the slippage is concerned, it isn't alarming. There are two major reasons why the net slippage has slightly went up and the gross slippage has slightly gone up. It is in respect of the two factors, that is our credit card and microfinance. And we were a little prudent in respect of expanding the unsecured portfolio in 5 states, especially in microfinance, where it was put into elections. And that really, the growth was flattish. That's number one. The second, the recoveries in, because the festive season and all of the disruptions in this, some of these states, our recoveries were not to the extent what we have been planning for. However, in the month of December, we revived back. Our collection efficiency has gone back to our plan of 99.4%. And in December, our microfinance collection is 99.4, leaving a very little for forward flow, and that is under control. Similarly, in respect of the credit card, also bounced back to that recovery position and the collection position as we have been doing it before Q3. As such, this small 0.62% of the net slippage isn't alarming. We are pretty confident that whatever the recovery we will wish to do it in the Q3, we'll be able to claw back in Q4, and we'll be back to our the normal position. However, when I just relate this slippage to the credit cost, we are well within the range of guidance. We will be in the credit cost between the 1.5 to 2% of the guidance what you have given. At the maximum, it will swing between 1.6 to 1.8, and we are confident of maintaining the credit cost guidance as well.
Okay, so confident of maintaining your credit cost guidance as well. Mr. Subramaniakumar, good morning. This is Sonia here. I think what really worked well is that the retail loan growth has been very strong this time. I mean, just look at the numbers, 33% year on year. Is this a loan growth that is sustainable over the next few quarters? And what has led to such a sharp pickup in retail loan growth? And what's the outlook for the full year?
Morning, Sonia. See, we have guided right to the beginning of the year itself that our focus is going to be on a retail and more so on the secured retail. We created a complete structure for that. The first what we did, we created a product which are not on the shelf of the bank. All these products were taking a time for establishing in systems, procedure, processes, and keeping people on the floor. That took around a couple of quarters. And now all of them have started picking up. For example, if I tell you, my total disbursements in retail is around 6,000 crores, which was somewhere around 4,000 crores 2 quarters before, and exactly year before it was somewhere around 2,000 plus crores. It is because of the fact retail housing, retail LAP, that is the mortgage loan, which was one of the major focus area we were able to thrust upon. Since we have originally we started disbursing these loans at 68 locations. Now we have expanded that to 186 locations as we speak this quarter, and which will start paying us or which will enable us to build this portfolio in the coming quarter. So we are confident that we will be able to maintain, will sustain the growth rate in the retail. Our guidance was that the total advances will grow by 20%. Within that, the retail grow in the range of around 25 to 30%. And within that, the secured will grow at 30%, which we are confident of doing it. In fact, this quarter, our secured retail grew by 50%, albeit the low base. And although we may not be able to do 50% quarter on quarter, it will never be below 30% what we have guided the market.
All right. Hi, sir. Good to see you. And Nigel on this side. You said you're confident of maintaining the credit cost guidance. What is that number for FY25?
It is in the range of 1.5 to 2%.
Got it. All right. So that's out of the That's out of the way. All right. The CD ratio currently for you, I think it's in excess of 85%. Have you heard from the regulator? Has RBI told you that they would like you to bring it down to a particular level? Any communication?
See, we ourselves are conscious about this CD ratio as per our strategic discussions within the board, as well as what we have communicated to the market as well is that we will be in the range of 85%. When we talk about the CD ratio, I would like to have a different perspective to be seen. We have an option of drawing our refinance for funding our loan growth, and we are also having a long-term effects. These two are long-term and it is sustainable. So when I try to do this refinance, we have seldom made use of it in our earlier avatar. We have just started using that for funding our growth. If I combine the deposit and the borrowings, refinance especially, and the ratio will be in the range of 73%. Having said that, our focus is we have made it very clear that the branch-based deposit growth, which we saw 23% in last quarter, will be able to fund our incremental advance growth of 20%. Hence, we don't see any stress as far as the growing the book is concerned. And our CD ratio will continue to be in the range of 83 to 85%. When we combine the refinance, it will be around 73 to 74%.
Mr. Subramanian, just on that point on branches, right? I remember reading this note from Spark event as the broker, and the analyst there was had written a note basically saying that, the fact that you are going back to branch basics is going to be a big game changer for you. Can you just explain that point? Essentially, the point was that your branches were essentially were focused on liabilities in a very big way. Most of the advances were coming through DSOs, etc. And now that is going to be it's going to be done via branches. Could you talk to us what change will this make, not just in the near term, but over the medium term? And if this is correct to begin with, go on.
See, traditionally, the bank has been using the branches for the purpose of mobilizing the liabilities. So you have a restricted way of doing it. Then we made an analysis and find out we have to leverage this investment which we made it in the branches. So in order to leverage that, we need to have the retail product. So we have just launched the product, around 7 to 8 products which we have launched it. And now all the branch people were facilitated for sourcing the leads for us retail assets. The retail underwriting, risk underwriting continues to be centralized. There is a separate credit department work on it. So all these branches hitherto looking at the liability as a source of mobilizing in their area of operation or catchment area, they are now started working on. Just to give a pointer, and year before they were not able to generate any leads for retail. Today, out of whatever the monthly logins we get, 25 to 30% of the logins are coming from the branch itself. This is going to provide two things. One, the productivity of the people deployed at the branches is go up, and which will in turn help us to manage our investment efficiently. The second, it will also provide us an opportunity to get the liability people on floor. Asset-led liability is another important strategic move which we have done. And this particular action has given us a lot of positive shootouts. And what we have seen is the number of customers who are being enrolled at the branches has doubled in this quarter over that of the corresponding last quarter, which itself is an indication that the strategic direction is right. In addition to that, what we have done is we have a subsidiary which is having around 1,200 branches. All these subsidiary plus BC put together is having 1,200 branches. And what we did, we identified 800 such locations, which we can leverage for the purpose of sourcing our liability. So now these touch points, we are moving away from the branch base to that of the branch touch points of the RBL, which we have said that. So 800 locations will be provided an opportunity to do the business through digitally enabled savings fund, digitally enabled term deposit. And these, they will be in their catchment area, they will be able to source it. I give a simple statistics. Out of this 800, even if they mobilize at 10 lakhs per month, 800 into 12 months, they will be able to add not less than 4% to my total base of the deposits. So this is an opportunity which we wanted to reap in, and the work has already started. The pilot is has been launched in some of the geographies. We are looking at the system issues and other process issues. Once it is streamlined in this quarter, and this will be also add up to our ability to add deposits in the bank.
Okay, all right. Final question, sir, before we let you go. Actually, final couple of questions. What is the ROE target that you have for FY 25-26?
Instead of getting into the ROE first, I will start with the ROA. We wanted to have an exit of around 1.1 to 1.2 this year, and there will be an increase of 20% year on year thereafter. And thereafter, with a leverage of around, let us say, 9 times, you'll be in a position to have at the end of 26 as mentioned document, which we are working also around 14% of ROE at the end of 26. This is what we have been aiming at, and we are on track.
14%?
Yes, on 26 FI exit.
20. Okay, got that. And any plans to raise capital?
See, right now, our capital adequacy is well maintained. In fact, this time, even after the sequential growth, we consumed around 65 bips. Even after the regulatory directions of increase in the RWA, we are confident, and we feel with this, we will be in a position to manage for next 6 to 8 quarters the capital sufficiently available with us.
All right, we'll leave it at that, sir. Thanks a lot for joining in. Appreciate your time here on CNBC TV 18.